Good evening. Good evening. Welcome to Economics 330, Global Trade and Political Economy. Today, of course, is Tuesday, November 18th, 2025. Welcome to Office Hour and Lecture. I am, of course, Professor Felix Obi. This is Module 11. And in today's lecture, we will discuss the role of multinational corporations, or MNCs, in international trade relations. This topic is important, not the least because MNCs, or again, multinational corporations, are responsible for a significant portion of goods that are involved in global trade. In today's lecture, and indeed through your assessment for this week, we will discuss some of the pros and cons of multinational corporations, their criticism and praise. In particular, we will discuss multinational corporations in the context of international political economy theories and perspectives. Now, here are your learning objectives for the week. The first is to identify multinational corporations, to which I would say multinational corporation is a company that has business operations in at least one country other than its home country. By some other definitions, multinational corporations also generate at least 25% of their revenue outside of its home country. Notably, some multinational corporations may have budgets that exceed those of small countries. Many multinational corporations are based in developed countries, but they can often have a positive effect on the countries in which they operate, especially as multinational corporations often make direct investments in foreign countries. Advocates say multinational corporations create high-paying jobs and offer technologically advanced goods in countries that otherwise would not have access to such opportunities or goods. The next learning objective is to explain why multinational corporations are criticized for playing deleterious roles in host countries. Critics of these enterprises believe multinational corporations exert undue political influence over governments, exploiting developing countries and creating job losses in their home country. I think President Donald Trump would argue that this particular argument is what he's trying to correct by the tariffs that his administration announced. That is, multinational corporations exporting jobs overseas at the expense of workers in their home country, and in an effort to increase their profit margins without necessarily passing on the benefits to consumers. I think the Trump administration would further cite as an example the automobile industry that has a supply chain that runs from Mexico, and indeed production facilities that run from Mexico through the United States to Canada. They would argue that this is unnecessary and absolutely unhelpful to American workers. And indeed, to the extent that tariffs is motivating the reshoring of jobs of manufacturing plants, especially in the automobile sector, back into the United States, then it may appear that this argument may have some validity. Of course, you want to always be careful of the danger of a single narrative, but Obviously, it cannot be discounted, fully outright. Um, Others argue that the history of multinational corporations is linked with the history of colonialism. Many of the first multinational companies were commissioned at the behest of European monarchs to conduct international expeditions. These early MNCs include, among others, the East India Company, established in 1600, the British multinational enterprise. This British multinational enterprise took part in international trade and exploration and operated trading posts in India, and indeed much of what is now India, Pakistan, Bangladesh, among other countries in the sub-region. The Swedish African Company, founded in 1649. Another company is the Hudson Bay Company, founded in 1670, and the Royal Niger Company, a mercantile company chartered by the British government in 1879 as the United African Company and renamed National African Company in 1881 and to Royal Niger Company in 1886. The third learning objective is to discuss the role that multinational corporations play in the transfer of technology and trade in the world. Consider that multinational corporations play a crucial role in the transfer of technology and trade in the world. By producing the same quality of goods at lower cost, multinational companies can reduce prices. Note the operative word can reduce prices and increase the purchasing power of consumers worldwide. Now, again, I've always argued in this class the importance of dialectical thinking, which is to see issues from all sides and not take a slapstick position to say, okay, this is good, that is bad. You could still, at the end of that evaluation, say on balance, I think this provides better value. But I also want to correct, because I had mentioned just a few minutes ago that those who argue, who support the ongoing tariff, or at least some of the ongoing tariff, would argue that when multinational corporations move their production facilities to lower cost countries, that they do not necessarily and always pass on the cost savings to their consumers, that this indeed only for the most part increases their profit margins. But even in cases, I should add that even in cases where this argument holds true, it is still not an us versus them scenario. Consider that many pension funds, which you would eventually or probably already or have investments in, hold stock in these companies. So the profitability of these multinational corporations is not an abstract phenomenon. It has real life and consequential benefits for ordinary people. So that is important to keep in mind, that even as we recognize that dialectical thinking requires that we have an understanding that there is a tension between having the potential to offer cost savings to consumers because goods and services are more efficiently produced, versus even when those goods and services are more efficiently produced, that the cost savings are not necessarily passed on to consumers, but is retained by the corporation as bigger margins. Even when the latter is true, it is important to note that you and I and most people do or will eventually have owned some kind of portfolio, some kind of mutual fund, some kind of a 401k that would hold some of this stock in the portfolio. So the profit is not in isolation to the general public. So that's a critical point to note. As such, on the other side of the ledger, there is a trade-off of globalization. The price of low cost is that domestic jobs often move overseas. This can increase unemployment in the home country of multinational corporations and make it difficult for long-term employees in outsourced industries to find new jobs. Those who take this view would argue that this is why the share of manufacturing jobs in the US economy is on the decline. Others would argue that there are broader forces that are behind that, and that may, on balance, not be a bad thing, that it may just prove that the quality of employment that is available to Americans has improved for the most part beyond standing on your feet, working on heavy machinery all day on a factory floor. So now, let's shift to learning outcomes. At the end of this week, you should be able to differentiate between foreign direct investment or control and portfolio investment, which is also called no control. Foreign direct investment control implies investment by foreign investors directly in the productive assets of another country. While portfolio investment, no control, means investing in financial assets such as stocks and bonds of entities located in another country. So foreign direct investment, to be sure, means that you're literally building a plant. You are building a hospital, right? Portfolio investment means, as an example, that you're buying up debt from that country. And I hope we all understand at a fundamental level what a bond market is. And let me just quickly draw a circle around that. So if you and I want to borrow money, obviously we go to a bank. Hopefully not a payday lender. Those are horrible. The rates are extortionist and you almost never get out of it. So I highly discourage anyone from even considering it, much less doing it. So you and I will go to the bank. The problem, though, is that when countries want to borrow money, the scale is usually too much for a single institution to loan them that money. I mean, they can go to a lender of last resort like the IMF. We've covered that in previous classes. Or they can put out bond. Bond obviously will be managed by a financial house or a bank, commercial, an investment bank. That essentially means that the house, the institution that is helping securitize this debt for this country would say they're going to put out a 5, 10, 15, 20, 30-year bond, whatever it is, and then they will determine a rate of return based on the risk profile of that country. So you and I, as an investment, could go back, purchase that bond. That really means that we ultimately are the people loaning money to that country and not the bank. The bank is just really the people that are securitizing the debt, or rather turning that debt into an investment. So, and this is what is called a portfolio investment. The other kind of investment, of course, as I just said, is a foreign direct investment, which is actually an investment into the productive assets of the foreign country. The second learning outcome for the week is to note that major decisions that a multinational corporation, so actually, a major decision that a multinational corporation should consider regarding how it selects and operates in a specific location includes, among others, opportunity for improved efficiencies, lower production costs, agreeable regulatory framework, and eventual larger market share and/or margins. So opportunity for improved efficiencies, of course, you want to have an efficient port where you can export and export finished products and import inputs for your manufactured products. You want to have an efficient bureaucracy that can quickly and efficiently adjudicate disputes or facilitate commerce. You want to have relative lower production costs, otherwise you'll stay in your home country. You want to also have an agreeable regulatory framework. And of course, you want all this ideally to lead to a larger market share and/or bigger margins. Another significant strategy for multinational corporations is transfer pricing. That is, when corporate tax rates differ between countries, multinational corporations have an incentive to set its transfer prices in a way that reduces its tax burden by reporting higher profits in the country where corporate profits are taxed more lightly. A typical example of this is the Republic of Ireland. I hope that by now we all know that there are two islands on the same island. There is a Republic of Ireland, which is an independent country on the same island that is a member of the European Union, as you guys covered in one of your assessments on the levels of regional trade agreements. There is also the Northern Ireland. Northern Ireland is part of the United Kingdom of Great Britain. So United Kingdom of Great Britain is Northern Ireland, Scotland, Wales, and England. I think that's all of it. So there are the nations that form the United Kingdom of Great Britain. Of course, the island of Ireland and the British British mainland island, they're called the British Isles. But I digress. Ireland, the Republic of Ireland typically has lower taxes than many of its EU partner countries. And as such, many multinational corporations are headquartered in Ireland. And they do this for the purposes of transfer pricing, right? Where they recognize part of their profits in Ireland and pay the relatively lower corporate tax. Which is why, if you were to look at, again, just zooming out again, and this is really for broader knowledge, and this is why folks can sometimes argue that GDP is not as helpful as a data point as economists often make it. You could look at Ireland as an example because of corporate tax strategy. Many multinational corporations recognize their taxes in Ireland. So, and this distorts the GDP numbers in Ireland and suggests that Ireland has a very high GDP. But frankly, most of those profits that are recognized in Ireland are not retained in Ireland and are not invested in Ireland. So the country, while it captures some benefits from the taxes, does not generally enjoy the full beneficiation that you would imagine would come from such a high GDP and high economic activity. So that is one of the things to note about transfer pricing with multinational corporations. So another is to differentiate the perspectives of liberals, realists, and historical materialists about multinational corporations. And we've covered that ad nauseum, and I'm sure everyone in the class should be able to teach a class on that. Lastly, please note the difference between horizontal and vertical integration. Horizontal integration is when a business grows by acquiring a similar company in their industry at the same point of the supply chain. Whereas vertical integration is when a business expands by acquiring another company that operates before or after them in the supply chain. So with that, I wish everyone a successful completion of Module 11, Multinational Corporations. I look forward to reading your assessments. Of course, you have up until 11:59 p.m. Friday to turn those in. As just to foreshadow next week, kindly note that our focus will be on international economic development. And with that, I'm going to turn off the camera, take questions as necessary, and then we get into our office hours. Thank you.